Swayam Prabha. Digital India. Educated India.
Hello everyone, welcome to this session on key concepts of national income. In this session, we will begin by understanding the difference between GDP and GNP, followed by a brief discussion on state domestic product to see how income is calculated at the state level. We will then explore the concept of GDP at market price and GDP at factor cost and understand the net GDP by looking at how depreciation affects the value of output with some practical examples. We will also break down how income reaches to the household level through personal income and personal disposable income and concludes with per capita income, that is, which tells us about the average income per person in a country. With the examples and simple calculations throughout, this lecture aims to make these macroeconomic terms easy to grasp. So let's now begin with the distinction between GDP and GNP. So about GDP, we have already defined it. GDP means the market value of all goods and services produced within the domestic territory of a country in a given period of time. And GNP, gross national product, is also called as gross national income. This concept is much broader than GDP concept. So, for example, to begin, India's GDP, for example, what is India's GDP means? India's GDP measures the production that is located within in India. But India's gross national product, India's GNP or GNI, measures income accruing to all Indian residents, all Indians. So the difference is due to net income from overseas. Main difference is the net income from abroad. So the concept, mainly what we do that, since we already learned in the previous session that the total product is equal to total income is equal to total expenditure. So the gross national product can also be called in another alternate name called gross national income or gross national expenditure. So let's come to the GNP measurement. So GNP is measured by adding net income from abroad to GDP. The other way around, the net income from abroad is income earned by Indians abroad. Indians abroad minus income earned by foreigners in our country, in our country, that means in India. That is how we define the net income from abroad. Suppose India we earn 100 billion abroad and foreigners earn here 90 billion. So the net income from abroad is, you can see that the $10 billion is the net income from abroad. So when we calculate GNP is calculated as GDP plus net income from abroad. So using the expenditure method, how to calculate GDP? Because using the expenditure method, we measured GDP as C plus I plus G plus export minus import plus net income from abroad. So using expenditure method, we can calculate GNP like this. That is simply GDP plus net income from abroad. But GDP using expenditure method, we already seen that C plus I plus G plus export minus import. So I am showing you some data from the GDP and GNP data from in India over a period of time. So this is collected the period starting from 1950s to 2023. So you can see that over the most period of time, India's GNP is less than GDP, except this period. Except here, you can see that only during this period, 1970s, 80s, end of 1970s and the beginning of 1980s, you can see that India's GNP was greater than GDP. That means at that time, India's net income from abroad was a positive figure. So now let's move to another concept. This you might have heard in couple of instances. This is called GDP and SDP. So the GDP, which we already defined, so let me repeat that. GDP is the total monetary value of all final goods and services produced within a country during a specific period of time, usually a year. So the scope of GDP is at the national level, and is in Indian case is published by Ministry of Statistics and Program Implementation. And the purpose is to indicate the overall economic performance of the entire Indian economy. To what extent, to a magnitude, Indian economy is growing. In order to measure that, we use GDP. And when it comes to SDP that we call gross state domestic product, this we calculate at the state level. So this is the total value of all goods and services produced within a specific state in India during a given period. So the scope is at the sub-national level and is normally collected and published by the respective agencies at the state level, normally Directorate of Economics and Statistics of each state, coordinated by MOSPI. And the purpose is made to measure the economic performance of individual states. Let us now move to another concept. That one is called GDP at market price and GDP at factor cost. So let's begin with the first one. What is meant by GDP at market price? So before that, let me tell you that normally what we report in general, is GDP at market price. So it means the total value of all goods and services produced within a country in a given period measured at current market price. So it includes the impact of taxes on products like excise and sales tax and excludes subsidies. So this is the GDP at market price. So simply GDP at market price means first it includes the GDP at factor cost, that means payments to all factors of production, wages, rent, interest and profit. That means GDP at market factor cost plus indirect tax. Indirect tax is normally levied at the point of production, that is called excise duty, and at the point of sale, that is called sales tax. So this has been added. Then the product subsidies, either received by the firm or even individuals, in case if they received any subsidies, mainly for production purpose, if they have received any subsidies, that has been excluded from the GDP from this calculation. So simply this means that GDP at market price means GDP at MP, this can be written as GDP at factor cost. GDP at factor cost is the one which I mentioned here, the first line, this line, plus net indirect tax is we need to add here. So net indirect tax here means indirect tax minus subsidies. So next one concept is the GDP at factor cost. So GDP at a factor cost means the total income earned by all factors of production. So it is derived by subtracting net indirect tax, removing indirect tax from GDP at market prices. Because normally what we get is directly we get GDP at market price. So in order to get what are the factors of production received, what is their income. So in order to get that, we need to subtract net indirect tax from GDP at market price. So here we already defined GDP net indirect tax means excise duty, VAT, GST minus subsidies. So simply to summarize this one, you can see GDP at factor cost equal to GDP at market price minus net indirect tax. If you take a numerical example, suppose if the GDP at market price is, for example, 110 million, then indirect tax is 10 million and subsidies, for instance, 0. So in this case, if you want to calculate GDP at factor cost, the estimation is like that the GDP at market price is 110 and minus net indirect tax 10 minus 0, that is 10. So what you are going to get is GDP at factor cost is 100 million. 100 million is the GDP at factor cost. Let's now talk a little bit about how the national income has been measured in India. So in India, the most highlighted measure of national income has been GDP at factor cost, because the main reason behind it is that because that is the real income that is received by the factors of production. Suppose the indirect tax, when the sales tax has been increased or the excise tax has been increased, then you can see that what we are getting is a GDP at market price, that is an inflated value. Suppose if you are using GDP at market price as the main measure of GDP growth, then in order to increase GDP, what we can do that we can add more indirect tax on goods and services, then we are going to get a high value of GDP at market price. So in order to overcome that, what we do that we use normally GDP at factor cost, that is the reward, the factor income received by all the 4 factors of production. So if you go visit the Central Statistics Office website, they have been reporting GDP at both factor cost as well as market prices. So in its revision in 2015, the CSO replaced the GDP at factor cost with the GVA at basic prices and the GDP at market prices, which is now called only GDP and is now the most highlighted measure. So as I mentioned, this one almost similar to GDP at factor cost. So let's see the difference between what is GVA at basic prices. So GVA at basic prices means GVA at factor cost plus net production taxes. And what is GVA at market price? That is GDP at market price means GVA at basic price plus net product taxes. So in this case, the distinction, I have highlighted the distinction here between production taxes and product taxes. So is mainly the production taxes mainly related to the production, not quantity. Examples are land revenue, stamp duty, etc. And the product taxes, this is mainly based on per unit or product. So the example is excise duty, that is the tax at the point of production, GST, import and export duty. So the current practice, as I mentioned, GVA is now reported at basic prices. So in order to derive GDP at market price, we need to add net product taxes to GVA at a basic price. We need to add. So in order to get GDP at market price, we need to add net product taxes to GVA at basic price. So as I already mentioned that the net product taxes is equal to product taxes minus subsidies. So net product taxes, also popularly known as net indirect taxes. So let's now get into another related concept. Most often we also report net GDP. Otherwise we also call it as net GDP, or we also call it as NDP, net GDP or NDP. So net GDP means GDP at factor cost minus depreciation. So depreciation means there will be tear and wear of fixed capital that we need to account by calculating the GDP calculation. So net GDP at NDP at factor cost, let us take an example here. For example, 100 is the GDP at factor cost and depreciation is, for example, 10. Then what we get is the NDP is 90. So normally on average in India, when you go through India's GDP figures, you can see that approximately 10% is the depreciation value normally accounted. So approximately 10%. So NDP is usually around 90% of the GDP at factor cost. So depreciation, it also called as consumption of fixed capital. That is the value of the amount of capital used up. That is the wear and tear in producing the output. So examples are delivery trucks rusting, smartphones or computers becoming outdated, or old machines in factories needing frequent repairs. So the farming example, a 10 lakh tractor with a 10-year life depreciates 1 lakh each year, and its value declines with use and age. So that means you can see that the lifetime of a tractor is, for example, 10 lakh. Then you can see that the depreciation every year is 1 lakh. So that we need to account. Every year when a farmer is producing goods and services, the tractor, what he is using, from there every year 1 lakh, there is a tear and wear of this tractor. That we need to exclude from the GDP at factor cost to get the NDP at factor cost. So why it matters? Why do we need to calculate net GDP? Because it shows the actual productive capacity of an economy, and it reflects the sustainable output as it accounts for the loss of capital assets. And it is useful for assessing long-term growth and investment needs. From the discussion from GDP, GNP and NDP, let us now move to a little bit more at the household level by discussing national income to personal disposable income. So one of the main concepts here is that personal income, PI. So personal income means the part of national income actually received by households. So it is the income that households and non-corporate businesses have left after satisfying all their obligations to the government. That is the amount available for individuals to spend or save, that is income minus taxes. So personal income is equal to national income minus undistributed. National income here means not GDP, here GNP. So GNP or GNI. After that we need to also remove the depreciation as well. So this national income here is gross net national income, net GNP. That is the value we need to get by the national income, by we mean here. So that means the net GNI or net GNP minus undistributed profits minus corporate tax minus net interest paid by households plus transfer payments to households. So the undistributed profits, it means part of firm's profit not given to the households. That one is called undistributed profit. Corporate tax means paid by firms to the government, mostly on its profit. So we can also call as profit tax, that is paid by firms to the government but not received by households. So net interest paid by households, that means interest households pay on loans minus interest they receive from savings bank account and other type of deposits. And then we have the last element here, transfer payments. So transfer payments are normally unilateral payments by government to the household for not for any service. So if you are simply getting pension, that's a unilateral payment. So pensions, scholarships, welfare benefits received by households without providing any service in return to the government is called as transfer payments. So we need to subtract all these elements from, in order to get the personal income, we need to subtract all these elements from the net national income. So then coming to the final one, the personal disposable income. So personal disposable income means the income that households actually control and can use for consumption or saving. So that means when you get, for example, 50,000 or 1 lakh from your job or any other income source, so out of that you need to pay some portion to the government as income tax. So when we are subtracting the income tax, so then we are going to get personal disposable income. So in what here mainly means, that is one element. So personal disposable income means personal income minus personal taxes. Personal tax, mainly income tax, is called direct tax. Mainly direct tax we need to subtract. In addition, we also need to subtract the non-tax payments to the government. For example, fines or fees to the government. So that also you need to subtract. So when you subtract these two components from personal income, what you are getting is personal disposable income. That is the income households can actually spend. That means either consume or save. Now then also get into another related concept, just to distinguish between national disposable income and national private income. So coming to the national disposable income, we already defined it. That is the maximum amount of goods and services available to the domestic economy for use, including current transfers from the rest of the world, such as gifts, aid and remittance. That means total income available to the entire nation, irrespective of whether public, for the government or for the private sector, for spending and saving. So that is national disposable income here. Then national disposable income means we already defined it, but the private income means the income that actually accrues to the private sector and mainly to the households and private enterprises. So private income here means factor income from net domestic product accruing to the private sector plus national debt interest plus net income from abroad and plus current transfers from government and other net transfers from the rest of the world. So the main differences I have listed out using a table, what it includes and what it excludes. So you can see here national disposable income, it means for the entire economy and it includes NNP plus all current transfers and it is mainly used for measuring national spending capacity. And private income, that only to the private sector, and private sectors earned, it includes both private sector earned income as well as unearned income. So this is for understanding the household or private sector receipt. So in the previous slide here I have used the term national disposable income, but in the previous slide what I have used was personal disposable income. So this personal disposable income is mainly for the household sector, what is available for them to spend after paying the direct tax to the government. But here in the next slide what I meant is not personal disposable income but national disposable income. So I just thought of clarifying these two concepts. So let's start with a small exercise, how to calculate gross national product at market prices and gross national product at factor cost from the following indicators. So in this table I have given you NDP at factor cost and then depreciation. This is the NDP at factor cost and depreciation. Net indirect taxes, you know, net indirect taxes means indirect taxes minus subsidies, and net income from abroad, that also you know, what Indians earn from abroad minus what foreigners earn from our country. So that is the net income from abroad. So all these four data points are given to you. From this, how to calculate GNP at market prices. So let us make the concept very clear. You need to go through systematically what each and every concept means. Then based on this table, you need to see which all relevant information, which all data are relevant to your calculation. So from this calculation, in order to calculate GNP at market price, GNP at market price means GDP at market price plus net income from abroad. So GDP at market price, already you know that GDP at a factor cost plus net indirect tax. What we have given here is only NDP at factor cost. So in order to get the GDP at a factor cost, you need to add depreciation to the net domestic product at a factor cost. Then you are going to get GDP at a factor cost is this figure. Then in order to calculate GNP at market price, remember all this formula, then accordingly adding GDP at a factor cost, net indirect tax plus net income from abroad, then you are going to get this value 1,84,590. That is the GNP at market price. Let's now move to what is GNP at factor cost. GNP at factor cost means GNP at market price minus net indirect taxes. So we already got GNP at market price here, so that we already calculated. So you subtract net indirect tax from it, then what you are going to get this value. Finally you are going to get, correctly, this value is correct. Now we have another related concept that is called per capita income. Per capita income is normally calculated by dividing the size of population. So in all the variable, whatever we calculated, you can calculate the per capita measure of these figures. So per capita GDP means GDP by size of population. Similarly, per capita GNP, per capita income at market price, per capita income at factor cost, all you can calculate. For that, you need to numerator, you need to take the matching concept. For example, per capita income at market price, you need to take GNP at market price divided by the size of population. So in this lecture, we have discussed various concepts related to GDP measurement. We started with distinction between GDP and GNP. Then we discuss state domestic product, and then we discuss disposable income, including personal disposable income. Then we discuss national disposable income and private income, and also we briefly touched upon the per capita income. And thank you for watching this video, and see you in the next session. Thank you.